Hey guys, welcome back to Real Estate Analysis 101. This is Paul Hunter. I'm a realtor here in Houston. I've been here for about 7 or 8 years. I am from Colombia, South America, so I know a little bit about high unemployment, high interest rates, and high inflation. Today we're covering a Zillow article says home prices declines are moderated in September. But first, a really quick thing. I am not a financial advisor, but I do appreciate likes, subscriptions, and comments to my YouTube channel. So let's get started. First, before we get started, though, I want you to make sure there's no doom and gloom from me. I'm just going to give you the facts, and you guys have to interpret. I'll help you with what I think they mean. But as I always say, economics is a physical result of psychological processes. So you can read the data in a way, and if there's enough people that read it in the same way, you'll have a result. If the same number of people read it in a different way, you have a different result. So again, psychological processes are really important in how people interpret data and then how they act and how the economy follows that process into a physical result. So let's first start, as always, with the definition of a balanced real estate market. A balanced market means that we have 6 months of real estate properties on the market, and it would take 6 months to, if nothing came on the market, that would use up that inventory. So if we have 6 months of inventory, it's called a balanced market. If we have more than 6 months, it's called a buyer's market. And if it's less than 6 months, it's called a seller's market. So for any time pre-pandemic, anything below 6 was a seller's market, right? So it got to the point where we were having not months of inventory, we were days of inventory. So it went from, say, 11 days of inventory to 19 days. That's almost twice as much inventory, but still crazy low. In other words, that doesn't help anything, really. So prices went up a lot, and people were expecting that, and so they got a lot of information that their neighbors were selling, and so on and so forth. And we were seeing about a 40% increase in 2 years. That's way, way above the normal trend, and we'll get to that in a minute. But the important thing is that Zillow is saying that, and I'll read this thing for you. Home prices declines are moderated in September thanks to temporary mortgage rate relief. The typical U.S. home value was unchanged in September from August. Also, listings now take 19 days to go pending rather than 11 days this time last year. Active inventory has climbed 3% above year-ago levels, but it's still far below pre-pandemic norms, still a seller's market. Rising rates through September have pushed unaffordability to new heights. So, home values flatlined in September, ending a 2-month slide in which they fell 0.4% from a peak of $359,719 in June. This reprieve in home prices decline may be thanks to a late summer drop in mortgage rates. In August, we saw that, to an average of 5.22. We are obviously above that right now, and we'll talk about that in a later video. The Fed just increased 75 basis points yesterday. So due to the elapsed time of multiple weeks between home purchase offers being made and the transactions closing, August's more favorable lending conditions likely affected closed price sales in September. Unfortunately for buyers, rates have risen dramatically since August, as we were saying, and reached a new 20-year high of 6.92 in mid-October, which is already past 7 as of this date. While national prices held steady, the tumble continued in many formerly hot housing markets. The largest monthly declines were Phoenix, Las Vegas, New Orleans, Riverside, and Austin. Meanwhile, prices continued to rise in the Southeast and Midwest, led by Richmond and Miami and Indianapolis. Taking a longer view, the run-up in Florida's home values is remarkable. All 4 of the major markets with greatest year-over-year home value appreciations are in Florida. That's Miami, Orlando, Tampa, and Jacksonville. So let's look at a chart. This is the median home price as it went. It's been doing this right now. If we see it right now, it's 358,000, somewhere in there. But if we look over here, this is the change month over month. So it went down in August, and then it went slightly up but it's like nothing, right? I mean, from month to month, it's 0.02%. However, it's still 12.9% above the market last year. In other words, we still have high appreciation in that sense. So as we were saying, we still have increase in the value of homes, right? We were 12.9% above the year before. Now let's look at what our inventory looks like. And our inventory at this point is pretty incredible. If you look at it, 2019 was a very good year. It was pre-pandemic, but it was a good year. It's before anybody knew anything about COVID, and it was a seller's market. Now, if you look at 2022, we still are very close to 2019. Now, obviously, we don't know what's going to happen here. There's a lot of stuff going on. We have the interest rates to look for, the inflation, and that's something that we have to consider very, very seriously. But still, it's a psychological thing. In other words, it depends on how we're going to look at the economic data. Now, okay, so we're back to looking at our inventory. Our inventory has climbed 3% above year ago levels, but it's still far below pre-pandemic, which is what we were looking at before. We're still a little bit below what we should have been last if we were like in a normal year. So again, the question is here, right? What's going to happen between October, November, and December of this year and the following year? I have a number of considerations. The first one is we have the Fed doing stuff like returning to high interest rates, and we don't know what that's going to happen. It seems to me that with the midterms coming along, again, this is not a political show, but politics do influence the way people think. So we have to take that into consideration. My position on this is that independent of what political party you are at, it's always better when the government is in gridlock. So if the red wave, as the pundits and the experts are predicting, we're going to have one party taking over Congress and then the other party taking over has the White House. So they will be at odds with each other. In other words, they'll be fighting each other so much that they won't be able to do anything. That'll leave us, the people who really move the economy in a real way, to do our thing and let the economy grow. One of the things that I look at is during the 90s with Bill Clinton was considered a great president in the economic sense, not because he did anything, but precisely because he couldn't. He was embarked on a fight with Congress over impeachment, over the special investigation regarding Monica Lewinsky and all this other stuff. So my thought is that if we can get the government to be at odds with each other, it's not a bad thing for the rest of us. So again, supply and demand, our supply is still low, which means that indicates that prices will remain relatively high. Now, demand is going to go down. So we'll have supply up here. Demand will bring some of that down, but it's highly unlikely that we'll be losing money. In other words, it won't be. So let's look at something that I want to show you guys here. We have the prices, the historic prices from 91 to 2022. Now, if you look at this yellow line is the historical price growth throughout. I mean, here's from 91 to 22, but if you can go farther back and you still get this 4%. So what this means is that if for all these years we've been below the trend line, right? And you could look at it one of two ways. Again, as we said before, it's a little psychological thing. Are these prices here correcting for this, that this was too low? Or is this showing us that perhaps we were here and we'll start losing value in the homes? I believe for a number of reasons, and I'll show you the next slide. This is the prices, how they were going, right? And this is sort of month-to-month thing of what we saw before the previous slide. But this is the one that is important to look at. So we have the orange is 2020, the purple is 2021, and the aquamarine is 2022. Now, 2020 was pandemic, so it's kind of a strange thing. But if you look at 21 and 22, they started getting closer. Now here in July starts growing, and it's still growing as we saw before, but we're still very close to us. In other words, we're still close to the extreme of the seller's market. And here's where we see this. Days on market. The days on market are still very, very low. I mean, if you look at this, the aquamarine again, it's 19 to 14. Percentage wise is a lot, but that's only 5 days. So, and we were going from 43 days, which was kind of normal in 2019 pre-pandemic, to it came down to 21 now, and now it's still 14. So demand is still high. Now, again, we don't know what's going to happen because it depends on, obviously, on what's going to happen between the interest rate, and are people going to fall out? The median income, is that going to be going up or down? Next thing, here is the important part. We're talking about the interest rates. Now, this is the annual percentage rate that we've been having, right? Till 2021. What we have right now is 5.97, and then the historical average is here. And then if you look at the average between 72 and 21, it was 7.81. The historical average between 1990 and 2021 was, well, way below. It was a couple of points below. Now, I understand a lot of people saying, well, it's crazy that we don't need to go that high. Well, this is true, but we're still looking at interest rates that are not crazy. In other words, you can't just take the interest rate by themselves. You got to look at, are the incomes growing? And as I said before, unemployment is really low, and hopefully that's going to make it put some pressure on wages to go up, which means people have more money, and that will be able to, if nothing else changes, which in economics is not very realistic, but if wages go up, that means that people have more money to buy stuff. As always, keep your eyes open for data trends and inflection points. All these little points here, what do they mean? We're going to go down. In other words, those prices that we were looking at before, home prices are not going to continue to grow at 15 to 20% a year. Okay, that's unrealistic. Now, the question is, if you bought a home in 2015 for $200,000, and you're going to sell it next year for $230,000, did you lose money or did you make money? In other words, if we were going to that trend, you should have been able to sell it for 280. So you could have sold it if the economy kept on going for 280. You're going to sell it for 230. So the question is, did you make $30,000 or did you lose 50? And the funny thing is that people will look at it that they lost $50,000 when in reality they're getting $30,000 more than they paid for their home. So again, it's I don't believe that we'll have losses in the values of the homes, of the properties. I think what will happen is that you will not get those high prices. So if your home was valued pre-pandemic at $400,000 and you sell it for, now you're going to be able to sell it only for $370,000. So did you lose $30,000 because you didn't sell it at $400,000? Or are you going to compare it to what you paid for your home whenever you bought it? So in other words, if 3 or 4 or 5 or 10 years ago, you bought the house for, I don't know, $300,000, are you making 75 or are you losing 25? So it depends on how you look at it. But in the end, the important thing is you have your goals well written down, set, and stay true to your goals. And there, even in the worst years, in the worst crises, people are still going to buy and sell homes. So the question is, are you going to be one of the few ones that sell your home quickly, or are you going to be the one going to sit there on the market and lose value every day? Things will never be the same. Can we get back to pre-pandemic normals? I don't think that's going to happen just because so many things have changed, attitudes have changed. But can they be better? My optimism says yes. In any case, if you're out there in the market, you've got to be good or you got to be careful. Or actually, it's better if you're both. Guys, signing off. And guys, I just hope you got some value from this video. Please let me know in the comments. You guys know I want you to gain understanding of the psychology behind economics so you can make better real estate decisions. I am not your financial advisor one more time. I'm just a realtor that wants to share my insights so you can learn from my mistakes and successes. Again, being out there in the market, be good or be careful.